Hey guys, how's it going? I'm farming today, but I ran in to record this video for us all on TerraLuna. So let's hop right into it. Let me share my screen with you guys. Okay. All right, you guys, let's just talk about what is TerraLuna. So currently, it's the largest decentralized open source public blockchain for algorithmic stablecoins. You guys can just follow me along here. I posted my notes so that you guys have something to look at and reference while I chat. Excuse me. The Terra protocol creates Terra stablecoins that consistently track the price of any fiat currency, which is really cool. So it's not just pegging to the US dollar like USDC or USDT. On this blockchain, on Terra's blockchain, users can spend, save, trade, or exchange Terra stablecoins instantly. The Terra network is quickly expanding network of decentralized applications, creating a stable demand for Terra, hence increasing its price. Okay, so what is TerraLuna? Terra is it's its own blockchain network with smart contract capability. Its consensus mechanism is proof of stake. Its governance token is Luna, which we know, I'll just check real quick. Luna is currently checking CoinGecko, it's number 11 by market cap at 14 billion currently. So the governance token being Luna, you guys know we've gone through it before. Proof of stake networks, this is how they work. They secure their network through staking their governance token. So miners stake Luna, which is the native currency on the chain, and they do that to mine Terra transactions. Every block period, the protocol elects a block producer from the set of staked miners. In the case with Terra network, the more you stake, the more likely you will be chosen to print the block. Okay. TerraLuna was founded in 2018 by this dude named Do Kwon, a South Korean software engineer, and he is now Terra CEO. He was quoted as saying that the stablecoin is the most important product in crypto, uniquely serving the currency function of cryptocurrencies. So guys, what he's getting at here is, you know, with most cryptocurrencies that we have going on right now, most people buy them to speculate on and trade due to the volatility risk opportunity profile, you know, where there's no risk, there's no opportunity. And so that's why we love the crypto market, we take advantage of it. So most folks don't want to use their crypto that has the potential to increase in value to buy things and sell that underlying asset. So what he's getting at is we really need a cryptocurrency that we're not afraid to spend, and the associated protocols for lending, borrowing, payment apps, etc., that go along with it. It's basically an ecosystem of real world payments and exchange of value. Enter TerraLuna. Look. Okay. So the TerraLuna value proposition, I wrote it out for us here. You basically hold your monetary assets in a stable coin form on Terra in one of their DeFi applications, where you will earn a high interest on those stable coins, which is not normal. Usually you earn a lot lower interest. You also get a network of payment apps and other financial services such as borrowing and lending on the Terra network. The network is secured by adoption or by people like you holding or staking your assets on the network, much like a bank account. Why did I write that? Well, let's just forget that last sentence. You guys know how it works with staking on networks. We've been through it a bunch of times. Terra is trying to make you know, these payment systems really easy by making the settlements instantaneous, super fast, and cheap. and also reducing merchant fees, which you guys know with credit cards can be quite high, keeping them to 0.5% or less to encourage more partners to hop on board. I think now they're at like what, 2.5% for Visa. And I think the reason why most folks don't accept American Express is because they charge like 3.5%, something like that. Anyway, correct me if I'm wrong on those Visa and American Express numbers, but they're definitely higher than 0.5. Okay, so that's an overview of what the Terra network was built to be, a network of algorithmic stablecoins. Okay, let's just close that and let's take a look at another page here. So that's Terra, and you guys always hear the same, they go together, TerraLuna. Well, what is Terra? What is Luna? Terra is the network. It's also whatever stablecoin that you happen to have created on that network. So you can have stablecoin that is pegged to the US dollar, to the Great Britain pound, to whatever you like. Luna is the governance token. Okay, this is the token. So it's a dual token system. The stablecoin and the Luna, they work together. And Luna is the one that we see on CoinGecko way up high at like number 11 or 12. It's been for the last little while. 14 billion market cap. It's the staking governance token recognized by the Terra protocol. It works by helping collateralize the Terra stablecoins and mediate the fluctuations in their price through arbitrage. So Luna secures the Terra network through staking. Obviously, we went through that. This is how proof of stake blockchains work. We should all know that one by now. You need to run a full node to become a network validator. So we know this is one of the things that maybe not so good about Terra, but we'll see how it develops. We know that the more validators, the better, the more decentralized it is, right? So the way that they have their algorithm set up is that, yeah, you have to have special hardware, you have to run a full node, and you have to be one of the top holders of Luna in order to become a validator. Currently, they have 160 validators, but they're hoping to double that to 300. Okay, and then I wanted to just kind of help you guys understand, because it's super challenging to figure out how this actually works, how they hold their peg when they're not backed by, you know, dollar to dollar, as say the USDC. We all know the problems with USDT, with Tether, and you know, at first they claimed that they were backed 1-to-1 with US dollars, and then since then it's become obvious that they have no transparency and they're perhaps less collateralized than we would all like to believe, considering we use it all the time. So how does it work to hold its peg algorithmically without being backed by the underlying fiat asset? So Terra, UST. So Terra, a Terra stablecoin that's pegging to the US dollar would be UST. You use that to pay network fees on the Terra network. So the more network adoption that happens, the more apps that are built, the more people that are using the network, the more fees that are going to come in. And that drives the price up of Terra. Okay. Now, we don't want that, right? Terra is a stablecoin. All of the stablecoins on there pegged to various fiat currencies. We want them to stay pegged. So how is it going to do that? So network usage goes up, price of Terra goes up. To bring that price back to the peg, we need to create more Terra coins. Thereby, we increase the supply and lower the price. That's how it works. So where do the new Terra coins, the stable coins, UST in this example that we're given here, where does that come from? Well, how the Terra algorithm works is you can swap $1 worth of Luna for 1 UST or whatever fiat peg you're using. For this example, again, we're using UST. So if The value of Terra rises due to the network effect. Terra goes up. $1 worth of Luna can be sold for 1 UST, which is worth more than the dollar. And in this way, we can make a profit. This is called arbitrage. This increases the supply of the stablecoin, hence lowers its value. Also, as a consequence, Luna is scarce and hence more valuable. Okay, so you guys, I know it's tough. There's a lot of videos out there on the internet that explain, well, there's a couple anyway, good ones. I'll post one that show visuals of how this works. You got to watch them a few times, but eventually you get them. You'll understand. You basically, well, just as I said, as the value of the Terra goes up, you need to bring that value back down by increasing the supply of Terra. And to do that, you basically sell your Luna, or you swap your Luna for a UST or for the stable coin, and that floods more of it into the pool and lowers the price back down. It's arbitrage. We'll talk more about arbitrage coming up. So staking rewards, you guys know how it works. It's basically like, so the way that these networks work with the proof of stake is you stake your governance tokens, and if you're not a validator, if you don't run a full node, then you stake with the validators. You delegate your Luna holdings to a validator, and then you share in the rewards. So the rewards, which are basically produced by transaction fees and gas fees on the network. It's not ETH gas fees. It's Terra has their own version of it. This is how they generate returns for their stakers. That gets delegated to as you win blocks and print blocks. Same. There's lots of other blockchains. Rewards from the stake are determined largely by the relative size of the stake and are structured in such a way that rewards increase as transaction volume increases. Okay, and then just as we talked about here, gas and tax, that creates the rewards for staking your Luna. Okay, I wrote in here, one bummer about staking Luna is the unstaking process takes 21 days. And during that time, this is a kind of a mega bummer. You can't sell that Luna. You're not earning anything on it. And it's just kind of like stuck there, stuck and locked in time. So there's 3 states of Luna. It can be unbonded, which is where you can trade it. You can do whatever you want with it. And then bonding or staking is a process that you go through, and that generates rewards. And then you go through an undelegation process, where, as it says here, no rewards can be transacted, and it's 21 days until you get back to this unbonding. Now, I didn't write it down in here, but I did read that if you're in a staking pool and you want to switch staking pools, instead of unbonding and waiting 21 days and then re-delegating, you can just change the staking pool. Like there's a way to change the staking pool, just to change which pool you're pointed to. But still kind of a bummer. We don't like that. Okay, another note here, there's airdrops because the stake, the stake is quite low from what I saw on their checking out their network explorer. They're saying that staking Luna was getting like 3.75 APY. So I don't like get why you want to do that instead of going with the Anchor protocol, but they're selling it with airdrops, and I guess the airdrops have been super profitable for Luna stakers. It says when new applications and their tokens arise in the Terra ecosystem, Luna stakers receive them for free as airdrops in proportion to their stake. Ooh, that is kind of good though. And then they're just saying here, if you're wondering whether it has been profitable for the airdrops, you can check it out. Where do they have that? They say they collected, Oh yeah, and then so when you're staking the Luna as well, then you can you're basically you can suggest protocols and stuff like that, and they can be voted on. I'm just reading here for a sec. It says, aside from the sheer value derived from arbitraging stablecoins and fees collected to Terra stakers, holding Luna for governance is an immensely underrated benefit. Terra is a DeFi platform, so all decisions are made by the community of Luna stakers. Community decisions include how to use funds amassed by the community pool. By the end of Q1 of this year, Terra had collected 24 million in Luna, amount worth roughly close to 400 mil today. Okay, so there's some rewards for staking your Luna. The airdrops sound pretty sweet. All right, let's drop that and let's take a look over here. So why stablecoins? Why would we want to, why are stablecoins important? So the stables are important because they, right here, retain purchasing power, right? That's not as volatile as other crypto currencies that we may invest in, and it enables simple low-cost payments. So let's talk about this for a second, retaining purchasing power. So because cryptocurrency is global, retaining the power means different things to different people and economies. So for some folks, the US dollar may be too volatile, right? There's lots of stuff going on with the US dollar, kind of similar to Tether. They're like, what is backing all of this? US has printed, I don't know, different reports, but like 30% of it's the total US dollars in circulation have been printed within the last year, which is never a good thing. So it seems pretty volatile right now. So anyway, Terra created a mechanism that issues regional stablecoins that can be swapped easily. So and sorry, just give me a second here. So you can have a Terra stablecoin in not just USD, but in any fiat currency as the peg. You can peg it to any fiat currency. These stablecoins are not backed one-to-one with the underlying currency. It is algorithmic. Okay, they are called algorithmic stablecoins. Crypto collateralized algorithmic stablecoins. These stablecoins hold a pegged value using a circular dual token system that creates arbitrage opportunities. So we just talked about that. And we already talked about how the Terra stablecoin and Luna work together to hold the peg of whatever the underlying fiat currency is. Okay, so why might we be interested in the Terra ecosystem? Well, it's fast, it's growing super fast in community and adoption. And there are some really exciting apps that have launched on the Terra ecosystem. If we were staking Luna, we would have got airdrops of them. So that's something to think about in the future. Utilities such as DeFi tools for trading, spending, and saving money. Two of these flagship apps are Mirror Protocol and Anchor Protocol. So aside from just helping us figure out what Terra is and Luna, their relationship, how algorithmic stablecoins work, I wanted to talk just a little bit about Anchor Protocol specifically, but let's look at Mirror too, because this is cool. As a whole new asset kind of class that's coming out right now. It's called synthetic. So Mirror Protocol, a crypto synthetic asset exchange. So let's talk about what are crypto synths. Well, they are derivatives. And then a derivative is any asset that derives its value from an underlying asset or index. Synthetic assets give us exposure to any asset in the real world through tokenizing the relationship between the synth and the asset. So as an example, if you want to hold Apple stonks without purchasing and holding actual real Apple stonks, you can use synths, or utilizing synths, you can trade an asset that behaves just like Apple, goes up and down like Apple. And oracles, you use oracles to track the price off the blockchain, which is pretty cool. Synthetic assets enable more liquidity across global exchanges than traditional derivatives are even remotely capable of. So shit's booming. You can tokenize anything in the real world, although they are fungible, but similar to NFTs, and bring it on chain and speculate and trade with it, which is pretty cool. So if you haven't read up on Mirror Protocol or synthetic assets, I suggest you do. It's pretty cool, and lots of opportunity there. So Anchor Protocol, because we've been chatting a bunch about, passive income opportunities, like how to generate passive income. That's what we all want to get to. We all want to be living on a beach somewhere, surfing every day, while the money that we have in our savings account is earning us enough interest to live on, right? Isn't that the dream? So Anchor Protocol, what is it? It is a crypto savings account offering high yields of 20% for the UST deposits. It calls itself the gold standard for passive income on the blockchain. It's actually the first line of their white paper. So you protect your principal underlying assets. So the money, like say from your traditional bank that you switched over to the Anchor Protocol, that money that you keep in your bank right now, especially in North America, you're basically losing a percentage of your money every year. You're not getting any interest at all. Interest rates are near zero. So you're getting no interest whatsoever. And in the meantime, the cost of goods is going up. So your purchasing power is going down. So that's never a good thing. We need to make higher yields on the money that we have if we want to even just protect the underlying principal. Okay, so in this way, this is a savings account. You can just think of it like a bank account, but you protect your principal, that underlying asset, by holding it in a stable coin pegged to whatever fiat currency you want, which is less volatile, while at the same time getting those high yields that we normally only get through more volatile, higher risk propositions, which is so sweet. The Anchor Protocol, there's 3 parts to it. You can be a saver, which is earning 20% APR, which is super good. A borrower, where you put down collateral, which for at the moment is only Luna, but in the future they hope to accept ETH, Solana, etc. And you pay an interest rate to borrow. We're gonna go and check out the website and talk more about this because there's some interesting stuff for sure. Governance token owners for the Anchor Protocol, the ANC token, participate in governance and earn dividends, okay? So the way that it works, to borrow money, saving is easy on Anchor Protocol. You toss your coins in there. I just did it today and I'll show you guys. You buy some UST and then you put it over and you into an Anchor account, and you start earning the 20% interest on it. Now, if you want to borrow, for borrowers, you put down collateral, which pays the saver's interest, the saver's APY. The collateral from the borrowers pays that. When the ratio of borrowers to savers is high, borrowing rates increase to make sure there's enough to pay the saver's interest. And when the savers to borrow ratio is high, borrower rates decrease to incentivize borrowing. That's basically how that dual kind of system works together to balance it all out. So let me take look here. Where is the bum, 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 bum. Okay, anchor. Okay. This is kind of rad because here's I disconnected my wallet. Well, we'll go through the process of how to do this in just a minute. But here's where you would connect your wallet. And I just wanted to show you the earn. So here's where you'll see your how much you've deposited in, and then here's the APY for right now. It fluctuates apparently. Has been as low as 17 to as high as 21, but stays pretty close to 20%. But here's the borrowing part is awesome because, well, let's talk about this net APR here. So to borrow, they're saying it's the percentage to borrow is basically 25%, 24.55%. But the distribution APR that you earn on the tokens that you put down as collateral is 36.5%. So the net APR, let's read this here. When the net APR, which is this here, is a positive number, which it is, it's 11.94, anchor rewards distributed to borrowers are greater than the interest to be paid for the loan. So yeah, so this is still what you are earning while borrowing. That's what net you come out with after you pay your borrow fees. So, I mean, this is pretty, pretty awesome, honestly. Okay, let's take a look at how to set up. Okay, so I wrote the steps down here and I will put it, I'll just kind of copy paste this into the Discord. So you got to pick up some UST to pay the network fees, right? So the network fees, just like you need ETH to pay gas fees to use the ETH network. To do any transactions, you're going to need USD. So go to, well, first you can download the Terra wallet, which is a desktop version. You guys, mega scam out now is fake email or fake web addresses. So make sure that you type it in exactly or go to the Terra homepage and then there's a link from there. So download the Terra wallet. I don't want to show you guys my wallet. I don't have anything blocked out, but I've downloaded the Terra wallet onto my desktop. Don't forget to write down your seed phrase. And also, hey, note to you guys, don't forget your password because I forgot my password today. This was cute to have a CBD. Don't forget your password. Otherwise, you need your seed phrase to reset. It sucks. Okay, so all you need is your Terra station. It's called the Terra station. Download it. It's on your desktop, and there's also a Chrome extension. So grab those two. From there, you can go to if we go to here, if we go to KuCoin, or sorry, if we go to CoinGecko, and we go, let's check out. Can you see my phone? No. UST. So if you go to CoinGecko and you can go to exchanges to see where you can buy USD. So Coinbase, KuCoin. It looks like KuCoin has the best liquidity. So I'm going to go to KuCoin. Go to KuCoin and they have plenty of pair options there. I chose the USDT because I happen to have some sitting there. And I bought UST. And then you're going to send that over to your Terra wallet on your desktop. Now, important when you do that, when you are withdrawing from KuCoin, just under the networks tabs, make sure that you, let's just see here. It's like network, bum, 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 bum. Do I have it up there? Where is it? Did I take down? Should I even show that? Okay, I won't show that. But you're going to go on KuCoin and you're going to do a spot purchase, market purchase of whatever you want to do. Just purchase on spot some UST. From there, you're going to transfer to your wallet on your desktop. And when you withdraw your UST, you're going to make sure you choose the Terra network, not the ERC20, because otherwise you got to pay gross ERC20 fees, which is yuck. And we don't want to do that. So when I was on there today, the ERC20 fees were $25 and the Terra fees was like $4. So you guys can choose. Just a note to you guys, if you already have the Terra in an Ether wallet, if some UST in an Ether wallet, you can switch it over using a bridge, but you're going to still have to pay ERC20 fees. Once you get it onto the Terra network, you're golden. Okay, so you have your UST and it's in your Terra station wallet on your desktop. And then from there, it's super easy. You just you stake. Let me find where my Terra is here. We'll go up here, Terra station. There's a tab right in there on your Terra wallet where you can just stake it. And then from there, you go onto the Anchor website and you connect your wallet to view your savings and rewards. And that's what we're looking at here. Hello. Where's Chrome? Here. So the very last part is going to this, which is just the Anchor, the app.anchorprotocol.com. And then from there, you'll have dash my page. You connect your wallet and then all of this stuff will come up. You'll see what you have there in your wallet. If it's earning, if you have it deposited, what it's earning, you can look into borrowing and on and on. Okay, guys, so that's it. I hope that was useful to you guys. And yeah, I'm pretty excited. I've started staking Luna and have sent some of my portfolio over to the Anchor protocol, which I'm really excited. I'll let you guys know how it goes. Okay, guys, talk soon. Thanks for stopping by.